Hi, I'm Michelle. Welcome back to Finally Revealed. In this video, I want to talk about a concept that's used in financing, but people might not understand what it really means. This phrase is upside down. The most common time that it's used is in reference to a vehicle loan. If you are upside down on your car, it means that you owe more money on that car than that car is presently worth. So that if you have $5,000 remaining to be paid on your vehicle from the loan from when you bought it, but right now, either due to mileage or it was in a wreck or simply the age, the physical age of the vehicle, it's not worth $5,000, it's only worth $3,000. That means you're upside down to the tune of $2,000. You can avoid being upside down in a car loan situation by paying cash for the vehicle when you acquire it, or if you are financing it, by having a short term on the payment of that loan. Some car dealers and other sellers of cars, in order to sell higher priced cars to people who maybe can't afford it at the time, will offer payment terms that extend out 5 or 6 years. When you are looking into buying a car, you need to look at what the value of that particular model is 5 or 6 years out before you enter into an agreement to buy that car for that term, because you don't want to be upside down on it. Meaning, if you ran into financial problems and lost your job or couldn't pay for the rest of the car, even if you sold it, you would still owe more money. So that is what upside down means. In the context of a house, it most often occurs when the real estate market, for example, a 2009 real estate market dive, the property values were corrected by the market, and people who bought a piece of property found out by the devaluation of the property when the market went down that their house was no longer worth what it was when they bought it. So they became upside down on their house. And when they went to sell it, hopefully they had paid down some money towards the purchase of it, but by being upside down, the total purchase price that they paid, including their down payment and their loan, was insufficiently covered by the later value of the house. So while they might have been able to sell it to cover the remaining balance under the loan, it was not enough to repay to them the equity, the original down payment that they had paid. And so economically, they lost money, even though they might have covered their loan. But that's what upside down means. You want to avoid it if you can. In the case of the real estate market, some factors come into play that you really can't plan for, but in your consumer items and other items that you finance, make sure that you have an idea of how that asset, if it's going to appreciate or depreciate. If it's a depreciating asset, get it paid off in cash or with the shortest possible repayment terms that are available. I hope this information is helpful to you. I'm going to be doing other videos on finance and other types of terms. If there's some type of a term that you hear about that you're not exactly sure what it means or how it would be used, leave us a comment. I'll be happy to cover it for you. And now I'll say goodbye, and I'll see you next time.